First off, what is PPE? And that's what we should start for. What is PPE? There's a definition for PPE according to IAS 2, but I'm just going to break it down, right? The most important thing for you to note is that number one, PPE are assets that you use for more than 1 year plus, right? You can't use it in 1 year and it ends there and say it is a PPE. No, it has to extend more than 1 year. That is the first criteria. Number two is that you use them in the production of goods. I take it again, production of goods. Don't mind the way I wrote my production. Production of goods, use them for the production of goods. So I use it to provide services. It's not only production of goods alone. You can use it to provide services, or you even use it in the supply. Supply. So just to make it simple, you use it to run your business, right? Use it to run your business. So it could be running your business could either be you're supplying products, or probably you are doing rentals to other, or you're even using this for administrative purpose. Let me just make it here. So it could be supply, it could be rent to other people, or it could be for admin purpose. So really, this is what PPE is all about, and I can give you lots of examples for PPE. One example is you could have delivery van. That's a very good example. You could have delivery plan. You could have generator, and so on. You could have factory machines, and so on and so forth. We're not going to take so much time on the examples, but really this is PPE. It could even be a building that is used as an office. I take it again. Remember we said admin, right? So building used as an office. So yeah, this is really what PPE is all about. Now, it's possible that people might misrecognize and a particular stuff and say, oh, this is PPE, and it's really not PPE. So let us talk about things that are not PPE. Let's talk about things that are not PPE. We can't call these items PPE. Number one, items that you bought to resell. Items bought to resell. We've already treated this particular one in the last video I made. These are called inventory. If you are buying a particular product to resell, that's inventory. It does not fall under PPE. Or take for example, short time items. Remember we said it must last more than 1 year. So short time items are really not PPE. What are short time items? Take for example, stationery. That's not like PPE. Or investment property. We mentioned building, office. Now building now is like a property, right? But imagine that you are buying that property for investments that, oh, we are going to make more money from it. This, and that is the sole reason why you bought it. Please, you cannot categorize, and I repeat, you cannot categorize it as PPE. This is treated under a different standard, that is IAS 40. I'm going to do a video on this very soon. So this is not PPE. Okay, so for us to know what is PPE, we must know what is not PPE, and I believe I've done a job in explaining that. Now let us even talk about what are the main characteristics of a PPE. Sorry for my short form. What are the main characteristics of a PPE? Number one, they are non-current assets. Remember, they are non-current assets, that is, they are fixed assets. Useful for more than 1 year. I've said this already. The most important one, they are used for production of goods and services. I think I've mentioned one, but the most important one that I want to mention here is benefit from heat flows to the entity. I take it again. Benefit from this particular item actually flows to the entity. And then the last one is the entity has control. I take it again. The entity has control over the use of the asset. Over the use of the asset. So really, this is the main characteristics of PPE. So with this, we've gotten a little introduction into what PPE is all about. Now let us look at how do you recognize PPE, and this is where we really start getting into what we're here to do. So how do you recognize PPE? Before you can recognize PPE, these two conditions must exist. There's future economic benefits. I take it again. Before you can recognize it, these two, I didn't say any of the two, both of it must be true. Future economic benefits, you're expecting that, oh, I'm going to get benefits from this asset, and I'm going to break it down. Or number two, it must be measured reliably. Measured reliably. Let me give you an example. Take for example, we buy a generator, right? What is the future economic benefits that we get from this generator? Number one is that if there's power outage, right? If there's power outage, we can use this generator. So that is the future economic benefit, because if there's power, then we can produce. If we are producing, then we can make money. That's future economic benefit. And number two is that we know the price that we bought this particular generator for. We know the price that we bought this generator for. So basically, this means that we can classify these assets as PPE. Now, if you are planning to buy the generator, is in the plan to buy a generator, that means you don't know the cost yet. You cannot call it PPE. I take it again. You cannot call it what? PPE. You cannot. It's not PPE. And until you have actually gotten it, you know the cost. You've actually purchased it, and you can get future economic benefits from it. That is when you can call it PPE. So I believe this part is clear. So we've talked about recognition. We've talked about the definition of PPE. Now let's move to part 3. How do you measure PPE? I take it again. How do you measurement of PPE? It's actually in two forms, right? We have the initial measurement and subsequent. Initial, from the name initial, means when you got it, and then after you got it, how do you measure? So what I'm going to be doing is that I'm going to start with initial measurement, and how do we recognize initial measurements? That's what we're going to be focusing on. The first thing that you must know is that when we're talking about initial measurement, we measure at cost. I take it again. We're talking about initial measurements. It is measured at cost. How much did we buy it for? And that is what you use to measure. How much do we buy it for? Right? But there are some other things that feed into the cost. Remember when we're doing inventory too, we said purchase price is not only purchase. We added some other things to it. So what are the things that form initial cost? What are the things that forms initial cost? Or you can call it the elements of initial cost. The first thing that you must put there is the purchase cost. Let's say we're working in Naira. The purchase cost has to be there. The second thing is, take for example, you imported it and all of that. You want to add your import duties. Very important. You add it to the cost. Note that everything I'm writing here are capitalized to the cost. So the cost of the PPE. What do I mean capitalized? It is not expensed. It is added to the cost of actually getting it. Or take for example, you have non-refundable, what they call it, non-refundable purchase tax. Non-refundable purchase tax. You add it to it, and then if you have trade discounts, it looks almost like the inventory, but not the same. You less trade discount on it, and this will give you part of the cost. I take it again, to give you part of the cost. Now, all of this is added to the initial cost. Let's now say you had to move that particular inventory, that PPE that you got. You had to move it. Then there are some other things that you want to add. So you want to have, what is the cost that we incurred to bring this asset to the location we want to bring it to? So you have things like cost of transportation. You want to add it. You want to add things like, probably you had to prepare the site that it was going to be. So cost of site preparation, it has to be there. Or take for example, you had to probably get there, and then you had to assemble it yourself. So assembly cost, there's an M here. Assembly cost, you need to add it. Or take for example, you had to probably borrow money. So it's called borrowing cost. There's an IAS on this actually. There's a standard on it. I'm going to treat it. I'm not very sure. I think it's IAS 23. Yeah. So IAS 23. There's borrowing cost, and so on and so forth. Take for example, you have direct cost. Take for example, you paid an employee to work on it. This is going to be added. But this is not all. Take for example, you know that we are going to use this thing for 5 years. So, and then after 5 years, we are going to dismantle this asset. You add it into it too. Cost of dismantling but you must do the present value of this. It must be a present value. So cost of this cost of dismantling the asset, you charge it to it. And really this is what makes up the initial cost of the PPE. So there's a lot of stuff that goes into it. So when you look at it, you see that we have purchase cost and everything that goes into it. I take it again. Purchase cost and everything that goes into it. Then what makes you bring the asset to location? Asset to location. That's where you have your assembly. That's where you have your transport, and so on and so forth. And then dismantling. So it basically consists of this. This is not an official. This is not an official definition, but this is the way I look at it. And as I look at it this way, I'm able to picture, like, okay, take for example, I have to add my purchase cost and things related to it. I have to take my cost of bringing it to the location and my dismantling cost. Once I look at that brief, I basically know what I am supposed to do. So really, this is how we measure initial cost. The next part that I want to talk about is that some things are not part of the cost. Not part of the cost. Things that are not part of the cost. Because ICAN, right? They're just going to put some things into the question. And you might think, oh, this is part of the cost. But really, they do not form part of the cost. Number one, you open a new facility. So cost of opening a new facility is not part of the cost. That is one. If you have overheads like all those admin and your normal overheads or general expenses, like, no, they are not part of your cost. Or take for example, which other one? You moved to a new location. Cost of moving to a new location. You really can't add those. Or take for example, you are introducing a new product or service. Exactly. Cost of introducing new product. You really cannot add this into your cost of PPE. So it's very, 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 very important to know. So that is it. And at this particular point, I would love to make clarification of some concepts. I'm going to try, because I'm going to be using this concept, and I can remember far back in uni, this particular word used to confuse me, especially number 1 and number 3. They do confuse me a lot. So I'm just going to be taking them one after the other, and we're going to be looking at what they mean. First one is carrying amount. What really is carrying amount? I'm going to give explanation, but just know that carrying amount is the cost of the asset. What is the cost of the asset? I think I've talked about it. Less accumulated depreciation. So you want the less accumulated depreciation, less impairment loss. We're going to talk about all of this, but just have this formula at the back of your mind. That once you remove all of this, what you have is your carrying amount. That is your carrying amount. What is accumulated depreciation? I believe this one is very, very simple. That's number 2. Accumulated depreciation is that just total depreciation on the asset. We bought the asset for 1 million. Depreciation is 100,000 every year. We've used the asset for 3 years. So year 1, year 2, year 3, 100K each, right? So that total depreciation will be 300,000. That is accumulated depreciation. And the third one that I wanted to talk about is impairment loss. There's really an IAS focused on this, like I said earlier on, and we're going to really do a video on this. In fact, I don't think I want to add this. Okay, impairment loss. So impairment loss is the amount by which, take for example, impairment loss is the amount by which the carrying amount exceeds the recoverable value. I take it again. The amount by which the carrying amount exceeds the recoverable value. So when we've gotten our carrying amount here, and now say that, oh, this carrying amount, is it more than the price that they are selling it in the market? So you have your carrying amount here. Let's say it is 1 million, right? And we now say, oh, let us now go and check in the market. Oh, how much is it? The fair value of it, right? Let's go and check in the market. Oh, let's just call it, because there's something called fair value. I don't want to use fair value. The recoverable amount. We now go and check on it now. On this asset, oh, what is the recoverable amount on this asset? And we say that, oh, if we should try to recover on this asset, it's going to be 800,000. So immediately you have this particular situation, then that means you already have an impairment loss. I take it again, an impairment loss. So if you're carrying an amount, that means you are carrying it higher than its true value in your books. So that means the carrying amount you have in your books is, like, in reality it is not up to this. Immediately you already have an issue of impairment loss. And there's a formula that we use to find impairment loss. So we have carrying amount. Let's say carrying amount is this, and then you have impairment loss. So you have recoverable amount. How much can we actually in real time recover? Oh, why is my razor not working? How much in real time can we recover from this asset? And that is our recoverable amount. And once you put it there, you subtract it. Whatever you have there is your impairment loss. Really, really important to put this at the back of mind. But somebody say, oh, how do I know my recoverable amount? Okay, how do I know my recoverable amount? Very important to know. This part should not even be in the video. I think I should just make it separate. So recoverable amount. How do you know your recoverable amount? There's a particular concept to it. So there are two things you must know. The first thing that you must know is, what is the fair value? Fair value is like, how much can we sell this thing? Less cost to sell. Less cost to sell. Like, oh, if we should sell this thing and the cost it will take us to sell, what is the amount less cost to sell? What is the amount we can sell it for? That is the one. And then value in use. If I should continue using this asset, what is the value I will get from it? The higher of the two is your recoverable amount. So higher of fair value, less cost to sell, and value in use is your recoverable amount. Let me explain what this means generally. So what it means is that you want to measure, if I decide to sell this particular asset now, and the cost it will take me to sell it, I want to sell it for 1 million naira, and it's going to cost me 80,000 to sell. So that means I'm going to be left with 920,000. Okay, but if I should continue to use this asset, I'll be able to gain about 2 million from it. So what is going to be your recoverable amount in this situation is the higher of the two, and the higher of these two in this case scenario is value in use, which is 2 million naira. So this is going to now be carrying amount minus your recoverable value, which will now form your impairment loss. That is if your carrying amount is probably around 3 million. So that means carrying amount is already greater than your recoverable value, and automatically you have impairment loss. Well, that was such a long-winded explanation. So yeah, let us move to other things. Let's say that we bought this asset, right? And after we still bought it, we still began to incur some other cost. I take it again. We begin to incur some other costs. They call it subsequent cost, right? And we're like, okay, what do we do to this cost now? Do we add it back to the cost? That is, do we capitalize them, or do we expense them? So not all costs, or not all subsequent costs that you can capitalize. Now, the ones that you can capitalize, number one, they actually improve the asset. I take it again. If the cost actually improve the asset, you can actually capitalize it. Or take, for example, it increases, it improves the asset, or it increases the life. Exactly. It increases the life It increases the useful life. Instead of it to be 8 years, now it is 15 years. Oh, then you have to put it there. Or take for example, it increases its efficiency or performance. Efficiency or performance. You want to capitalize it, right? Or you replaced some parts. Very important. So these are the reasons why you capitalize. I take it again. This is the reason why you what? Capitalize. Any other one, you expense them, right? So take for example, you are improving the assets, you are improving the performance by either you are extending the life or you are enhancing its performance. You capitalize that. Or if you are replacing a part of it, you what are they calling it? You also capitalize it. Though the part that is being replaced, you treat it as an item that you are supposed to be disposing. So this is for subsequent cost. Now, what about measurement after initial recognition? I take it again. Measurement after initial recognition. That is, okay, we've recognized this the first time. What are we going to do the next time? Measurement after initial recognition. There are two ways actually. There are two ways. Is that you carry it at cost. We call it cost model. Or you can use revaluation model. Both as their way. Remember, we are still on aspect of number 3. Is that number 1, you carry it at what? Cost model. Or you carry it at revaluation model. And each one has their own unique way. So what is cost model? Cost model is just basically you do cost minus accumulated depreciation. Cost minus accumulated depreciation. This is for cost model. But if it were to be revaluation method, revaluation model really is cost minus accumulated depreciation minus impairment loss, if there's impairment loss. Or another way to say this is that, what is the fair value of this thing? I think this is a better explanation. What is the fair value of this particular stuff? That is, if you want to sell it, what is the fair value of it minus accumulated depreciation? Then this now forms our revaluation model. But if you are doing revaluation model, number 1, you have to be revaluing the asset every time, like regularly. You must be revaluing the asset regularly, and then it has to be applied to the entire class. You can't use this for one asset. I take it again. You can't say, this is our Toyota IAS bus, let us use revaluation. Then our Jeep, we are going to be using depreciation. No. Everything under if you decide to use revaluation, everything under your transportation, right, logistics, that class of assets, everything will be what? Revalued. The most used one for people is actually the cost model. That's the one that people actually what? Use. So really this is about it. I know there are still more aspects to explore. So, and there are some important notes to note. And take for example, first thing is that if an asset has different parts, let's say an asset has different parts, right? What you want to do is that you want to revalue, you want to take those assets, you want to depreciate them separately. Take for example, an aeroplane now. Yes, you depreciate them separately. I take it again. An aeroplane, let's say it has 2 parts. We have the body and we have the engine. Now it's possible that the body, we have a useful life of, for example, 10 years. No, let's say the body has a useful life of 20 years and the engine has a useful life of 8 years. Now when you look at this, you want to depreciate this particular asset separately. I take it again. You want to depreciate this asset separately. You don't want to depreciate it together. So you do depreciation for the body and then you do depreciation for the engine. All right. Why don't we depreciate land and building? Why don't we depreciate land and building? Number one is that it has an unlimited life, so why do you want to depreciate it? So those are another key things to note. So to wrap it off, I'm about to close this PPE. Like I said, it's one of the longest. It's one of the longest one. Is one of the longest one among the IAS. When do you know when to commence depreciation? When do you know when you are supposed to start depreciating an asset? Number one, when it is available to use. Immediately it is available to use, you start depreciating immediately. So and when it's available to use, it's either about it is in condition or it is ready, we've assembled it, or it is already in position, or transportation is done. Then of course you want to start depreciating. When do you cease? When do you stop depreciating? Number one is you decide to sell it. Immediately you say, oh, let us hold to sale. There's a particular IAS on this. I can't remember it. There's an IAS or an IFRS. I think it's an IFRS. We'll do a video on this also. And when it is recognized, when you're like, oh, we're not recognizing again. We're not recognizing this asset again. So this is the two bases of stopping depreciation. So whichever one comes earlier, you could decide to hold it for you might decide to hold it to sale before you recognize. Whichever one comes earlier of the two, that is when. So earlier of when it is held to sale or when it is recognized, that is when you cease depreciating. Another thing I want to talk about is the straight line method, the different methods of depreciation that we have. I know we've done this over and over again. Of course, we have the straight line method. The straight line method, the formula is cost, everybody knows this, minus scrap value over useful life. Easy, right? Cost minus scrap value for useful life. Another one is the reducing balance method, which is a number of years over a square root residual value. Yes, number of years square root of residual value over cost minus 1. This is the reducing balancing method. Remember, we talked about carrying amounts, we talked about recoverable amounts, and we talked about impairment loss. Please do not forget this. I said impairment loss exists when carrying amounts exceed our recoverable amounts. We said recoverable amounts is two concepts: fair value less cost to sell, right? Fair value less cost to sell and value in use. Whichever is higher of these two is your recoverable amount. I wish you good success in your exams. I wish us good success. So you might want to watch this video again, and like I said, you can use it for your revision, or you can use it for the introduction into what the whole concept is all about. I'll see you on the next video. Bye.